I bought my first rental property 8 years ago in Chicago, and the quote that I got for it was $6,500. And my mind was, I just could not believe it.
You having experience in the insurance industry has probably helped propel the origins of Steadily. You mind talking about how Steadily has grown in those 5 years?
Insurance is an industry that's incredibly capital intensive. The entry point for starting an insurance company is typically like 30 million in capital, and then it only goes up from there.
Most people, if they own a home, they get a residential policy for their home. What's the difference between that and the policy that an investor will get for a home that they have as a rental property?
A homeowner's policy is specifically written for the policyholder to be living in the property. A dwelling policy specifically says this is not owner occupied. So the single most important distinction is that line that says we're going to insure this property even when you don't live in it.
Darren, what initially got you in the real estate space?
The way that we got started was...
All right. Welcome to an episode of the Agent to Investor podcast, where we talk about the agent side of real estate investing. We'll be talking about the successes, the failures, and all in between. My name is Nico Garcia, local real estate agent and investor based out of Montgomery County, Maryland. And as always, I'm joined by my co-host,
Anna Bilek, Northern Virginia realtor and mostly out-of-state investor.
And today we have another special guest. We have Mr. Darren Nix, the CEO of Steadily Insurance. Welcome to the show, Darren.
It's really good to be here with you, Nico and Anna. I'm looking forward to the conversation.
Awesome. And yeah, we're super excited to talk about the topic of insurance. And I know we briefly talked about it on a few episodes, but we wanted to kind of do a deep dive because it's a very important topic. But before we actually go into insurance, you mind giving a quick intro, Darren, of where you're from and what initially got you in the real estate space?
I bought my first rental property 8 years ago in Chicago, and that was what got this whole train rolling. When I went to get a quote for the property, it was a 3-unit walk-up in Chicago. If you've ever been to Chicago, you've seen hundreds of thousands of these properties. And the quote that I got for it was $6,500. And my mind was, I just could not believe it. I was like, really? This is what it's going to be like as a property investor? I'm going to have to pay this for a property? And so I went to another agent, got another quote that brought it down a little bit, and then finally found a third, and it ended up getting the price down to $2,500. The sheer difference between $6,500 for one and $2,500 for the third set off so many alarm bells in my mind because I came from an insurance background way back in the day. And I was like, whenever you see this much variation in price, the market is not operating efficiently. And that was the first aha. And then over the next 2.5 years, as I bought more rental properties, insurance kept coming up as either a mispricing or a pain point, getting declined for various things, having claims. And it all snowballed into there needs to be an insurance company built specifically for rental property investors. And that's what Steadily became back in 2020.
So before buying your first rental property, what did you do? Were you always a real estate investor, or were you in some other genre of work?
I started my career in the insurance industry serving auto and homeowners insurance carriers on the tech side. And my background is as a software engineer. And so the last 15 years leading up to Steadily, we're building various software companies in and around commercial real estate, the mortgage lending industry, insurance price comparison. So always in and around either insurance or property. And Steadily would just brought everything together into one company.
Wow. Talk about like a skill set that then a niche fell in your lap that you were perfectly suited for.
Yeah, they call it, so there's this idea of like product market fit, when you make a thing that people want. There's also the idea of founder product fit. And Steadily for me was like, okay, this is the one. Like it checks all the boxes for me. And I still get a code maybe 10 to 20% of the time at Steadily. So I haven't lost my engineering muscle. And that's one of the things that I love about being a founder is I get a little bit of discretion to say, all right, it's Wednesday, no meetings, I'm going to code today.
But you mentioned a great point, Darren, like fixing a problem that already exists, and you having, your experience in the insurance industry has probably helped propel the origins of Steadily. So I know you mentioned it began in 2020 and it's grown a ton since then. You mind talking about how Steadily has grown in those 5 years?
Yeah. Insurance is, for better or for worse, insurance is an industry that's incredibly capital intensive. And so the entry point for starting an insurance company is typically like 30 million in capital. And then it only goes up from there. Because if you think about what's happening, you are acting as a guarantor on potentially tens of thousands of properties. And if a hurricane comes through or a tornado sweeps through the Midwest, you have to be able to write $100,000, $250,000 checks over the weekend. Like that's what it takes. And so the capital you have to do it is really intense. And so the way that we got started was we first created a retail agency, expanded to all 50 states. And then we created what's called an MGA. And then we eventually created our own insurance carrier. And over time, just kept moving up the ladder of risk bearing until we got to the scale that we're at today. And as of now, we're in 45 states and we have over 100,000 customers and are insuring many billions of risk across the country.
What's an MGA from a non-insurance person?
An MGA it stands for Managing General Agent. And what it basically means is that you go to a insurance carrier that is not currently writing that type of insurance, and you say, we're going to request to use your balance sheet. So you will ultimately retain most of the risk, but we are going to do all of the underwriting, the claims, the regulatory filings, all of the customer acquisition. So we will do everything using your balance sheet. And then over time, as you grow, you as the MGA can also have opportunities to bear some of that risk yourself.
Got it.
I got nothing else.
So Anna and I are both Steadily clients. We use Steadily insurance on our investment properties, and we love the ability to get a quote very quickly. And I know you talked about this on previous interviews, but you and Steadily talking about the possibility of getting a quote, which would vary a bunch when you originally started this. How important was it to actually be able to give somebody a quote within a couple minutes for their investment properties?
Table stakes, I would say. When I compare what we're seeking to build, I compare us to what it's like to get a car insurance quote from Progressive. I've alternated between Geico, Progressive, and a few other carriers across the last 20 years, but the universal experience that I have is you go to that website on the day when you bought a new car or your insurance is about to expire, and within 10 to 12 minutes, you have an affordable, high quality policy done. It's pretty seamless, and you know that you have a good company behind you that's going to be there when you eventually have a claim. For me, getting to that level of experience for landlord insurance customers was table stakes. We, of course, have the phone number, we have the web chat, we have the email if people want to ask questions, but the default experience needed to be you can come to the website and in a few minutes, you can have the right policy at an affordable price done without necessarily talking to anyone. And that is easy to say and took us 2.5 years of engineering to make it happen with a very large engineering team. So it's incredibly difficult to do because if you think about it, let's say that you have 2 properties in Memphis, Tennessee, and one of them is $120,000 and the other one is $220,000. All you really know about that property is maybe the year it was built and the square footage and what they're asking to insure it for. And yet one of those properties might be a fix and flip that's currently boarded up and has a bunch of dump trucks in the front yard where they're doing a bunch of demolition on it. And the other one is fully occupied with tenants and is already cash flowing. The insurance risk on those 2 properties are night and day different. And being able to figure out those differences and price them correctly and give someone the right policy in a few seconds is technically very difficult to do. So that's where we had to invest a lot of energy and data sources to be able to make it happen.
Okay. I'm the one that totally goes off script, so I'm warning you of that now. I don't ever follow Nico's script. For those that don't know, what is the biggest difference, I guess I'll say, between, because most people, if they own a home, they get a residential policy for their home. What's the difference between that and the policy that an investor would get for a home that they have as a rental property instead? And why is it so different if it is?
The most important distinction between a landlord insurance policy and a homeowner's policy is that a homeowner's policy is specifically written for the policyholder to be living in the property. And so when the insurance company is underwriting that risk, they're evaluating you as the owner, like your prior experience, filing claims or not, your financial history. That's what they're evaluating. A dwelling policy specifically says this is not owner occupied. And so it's much less important who the owner is and much more important the characteristics of the property, who they're renting to, who the property manager is. And so the single most important distinction is that line that says, we're going to insure this property even when you don't live in it. Because if somebody hypothetically were to go out and have two rental properties and they got homeowners policies for both of them, one, they would have to intentionally misrepresent that to the insurance carrier. And then secondly, if they eventually had a claim, if it was a large claim, the insurance carrier is going to go in and investigate like who's living there and what was going on. And they would say, you're not covered for this because you misrepresented that you were living there. And as a result, you don't have the right coverage. So that's the most important distinction. There are a few technical differences as well. So with a dwelling policy, you're probably not going to need to buy as much content or like personal property coverage, because chances are all you have in there is like a washing machine and a refrigerator. And so you don't need $150,000 worth of property coverage. Maybe you can get by with like 20, and that can bring down the price a bit.
Got it. Yeah, no, that's a good point. Cause, if somebody buys a home, for example, and lives in it for a couple of years and ends up moving out and renting their actual primary residence, you brought up a great point, like a year down the road, and somebody files a claim, there's a fire or something, and that person actually isn't living there, they're renting it. They might not be covered. Correct, Darren?
Yeah, that's essentially it. Because the whole idea of insurance, there's this phrase within the insurance industry, there's no such thing as a bad risk. There's just bad prices. So if somebody comes to you and they say, hey, this property just had a fire, nobody's lived in it for 6 months, the roof's caving in, but I need insurance. It's risky, but it's not a bad risk. There's a price at which an insurance company will say like, okay, I'll give you coverage. Whereas if somebody comes and says, hey, I've been living in this property for 30 years. We've never had a single claim, and this is an ultra safe, high, very unrisky property. The rate's going to be much lower, but neither one of those are good or bad risks. There's just different prices on them. And so from an insurance carrier's perspective, they're working very hard at the time of quote to figure out what is the right price for this risk so that I can make a 3% profit. Because the profit margins in insurance are tiny. Like as an industry, property insurance, they're about as profitable as grocery stores. And so they have to get that price right. Otherwise, they're going to lose money.
Okay. So it's a good reminder if you own a home that you live in and then you move away, because I assume in a lot of cases, that's probably not even intentional. That's someone that thinks I'm moving out, and then they just keep rolling over the same policy because it's automatic, or they may have an auto deduction. So that's a good reminder if you're going to move out of your primary and rent it to change your insurance plan.
And I think that's correct. And it's a generalizable insight. Whenever something changes, that is when you need to reevaluate, is my insurance still correct for this new situation that I'm in? So changing the type of tenant, changing from a long-term rental to a short-term rental, going from long-term occupied to substantial vacancy, especially over 30 days, like those are all changes. And you want to raise your hand and ask your agent, hey, am I covered?
Speaking of changes, Darren, like something like if you get your roof replaced or things like that, is that something that you would want to also talk to your insurance agent to get updated for your quotes?
Yeah, because a new roof in many cases can increase the value of the property. So you're going to want to make sure that if the property then burns down, that you're covered for that full cost, because now you have more money to the property. If you do a bunch of upgrades and renovations, you want to make sure your limits are set. And then especially if you did something on the roof that made it storm resistant, like you put in a metal roof especially, yeah, that could potentially reduce the cost of your insurance pretty substantially. Because if you live in, let's say, Dallas, you're going to get hail damage, and that's going to be reflected in the price of your insurance. But if you can show the insurance company that you put in a hail resistant roof, you're probably going to pay less for insurance.
Got it. Got it. So one thing that you touched on just now is, being able to get insurance on short-term rental, midterm rental, things like that, because you're an investor-friendly insurance company. And a lot of companies don't do that. So what would be the difference in a policy on like a short-term rental versus like a traditional landlord rental insurance?
Short-term rental policy is typically going to cost 7% more than an equivalent long-term rental. And most of that difference comes from having higher personal contents coverage because they're furnished. And so there's more stuff. You have longer periods of vacancy when a leak can turn into something much more substantial because it takes a week to get caught instead of a day. So it's a little bit more expensive, but not dramatically. But it's great because then you're getting coverages like loss of use. So if you have a rental property, whether it's short or long-term, and a tree branch falls on the roof and it's out of commission for 4 months and you can't rent it, if it's a covered peril like that, the policy is going to pay for your loss of use, your loss of rent, which is what you would have made had it been habitable.
Okay.
Yeah.
And I'm
I
curious.
think it's important. Oh, sorry. Do you have check?
No, go ahead, Anna.
No, it was gonna kind of go back to the policy, like notifications and different types of policies, because we had a property we bought that was gutted. So we started with one insurance policy at one value while it was under construction. Now it's completed, but it's vacant. So we had to get a different policy adjustment because the value of the house is now different. And then we'll need a different insurance policy once we get it rented. So I guess that's the things that people don't think about. Again, just like with someone moving out of their house, they're like, I got a policy is a policy is a policy. But that's not the case. Like at each step, it makes sense to have your trusted insurance person to talk to and say, what's next, right? Like it's different at each step.
Right. So you went from a builder's risk policy to a vacant dwelling policy, and eventually you'll go to a traditional dwelling policy. The good news is they're probably getting cheaper with each one of those iterations, because the price of a policy should be telling you implicitly what the probability is that something bad is about to happen to your property. The builder's risk policy is going to be the most expensive because when you have open drywall with a bunch of copper pipes, there's a decent chance that somebody's going to come by the property with a truck and all of your pipes are going to be gone overnight. Fires, much easier to start when the wood is all out there and exposed. Like bad things happen to properties when they're under construction at a higher rate. And then once you get the property built, like, okay, you've got the fire alarms turned on, there's electric, like those things. So the risk is coming down a little bit. But if something goes wrong, there's nobody in the building. And like people break in and vandalize it. So that's why it's going to be still higher than when you finally get the tenants in. It's occupied, everything's finished. That's going to be the least risky time for the property because anything that goes wrong gets caught pretty quickly.
Okay. And how does the value of the property impact, I guess, the policy quote? Because like when it was gutted and there was nothing there, it was one cost to rebuild it if we were going to rebuild it to what it was before it was gutted. And now it's brand new, sparkly and shiny with all new appliances and everything else. Like there's a difference because you're looking at rebuild value, not necessarily what the city says it's worth or whatever, right? Am I misquoting that?
Absolutely right. And it's something that surprises people the first time that they go to get a quote, where they might go and get a quote on a property that they only paid $130,000 for. And the insurance company is saying, hey, the minimum I can insure you for is $250,000. And you would say, why? I only bought this thing for $130,000. Well, because if it burns down, they can't rebuild an old structure. They have to actually rebuild it. And then it's going to be a new property. So what's the cost to rebuild it if it burns down? That's what your policy limit needs to be. The flip side also happens. So I've had folks buy a property in like a high value area in Virginia Beach, and they bought the property for like $1.2 million. And then the insurance company was only offering them $600,000 worth of coverage. And they were irate. They're like, wait, what? You're trying to rip me off. I'm paying $1.2 million for this property. And the agent's like, yeah, but the land is worth $800,000 because of where it's located. Like the actual structure only will cost like $500,000 to rebuild. So if you bought $1.2 million of coverage for this property, you're like wasting tons of money because the structure is the only thing you're insuring. You're not insuring the land, just the structure. So just insure for the rebuild cost. And that can vary tremendously based on the value of the land and the age of the property.
That's such a good point, Darren. So I know you guys work in 50 different states, and how are is your team calculating rebuild costs on? I know there's a lot of uncertainty with what's coming on with building materials and things like that these upcoming months, but I'm just curious to for the actual fix and flip, the builder's trust insurance. How are you quoting that for rebuild costs?
The formula is not that crazy. You are basically using recent sales and recent transactions combined with tax data to say, okay, houses in this area are selling at this amount. The land value is another amount, which you're typically getting from tax appraisal data. So you can subtract out the value of the land. And then you're running a calculation based on the typical cost per square foot to do construction in that area. So you're going to see very different cost per square foot construction in California versus Nevada, for example. And so that's going to factor into it, but it ultimately boils down to recent transactions in the market, tax data on the value of the land, and then an estimate of construction cost per square foot. And that comes up with generally a range that plus or minus 20% is about there. And the only times that we feel like we're significantly wrong is if our data is based on a property prior to like a tear down rebuild, in which case like the estimate could be very, very wrong.
Yeah. So, So talking about location, that reminds me, because I've talked to insurance brokers that are really more residential, not so much investor type, but like how is Steadily handling all of these natural disasters that are hitting? In a lot of cases, they're high like vacation areas, which I assume are short-term rentals or like vacation, like second homes and rental properties. How is Steadily navigating all the flooding, the tornadoes? I mean, certain places are getting completely wiped out. Like, are you seeing Steadily pulling out of certain markets because of that? Because some insurance companies have.
We are not. And this goes back to the point that I made earlier that there's no such thing as a bad risk. There's just bad rates. And if you look at a property that is coastal Tampa and you do the math of frequency of hurricanes and you say, this house is going to get totaled once every 20 years. And that's the number. So then you say, okay, if I need a small profit margin to cover the operating expenses, then you say, I have to charge 1/15 of the property value per year to insure this property because I know it's going to get torn down every 20 years. And then that's what you charge. And that's one of the reasons why in California, or I should say in Florida, the rates for insurance are 5 to 6 times what they are in Austin, for example, because it's just explicitly baking in that probability that the property is going to get destroyed every decade or two. So you can insure in all of those areas as long as you have a very healthy cash reserve for when those like 1 in 10, 1 in 20 events happen. And then secondly, that you're accurately modeling the risk of what we call them CAT events, catastrophe events, where it's not that one house caught on fire. It's that, 1,000 properties just got flattened. And you have to be able to handle all of those damages at one time.
Yeah, which is something investors, again, another one of those things they don't think about with insurance costs, and they pick a market not realizing how high insurance costs can be because they're focused on cash flow at the beach town that they want to buy in. So, but insurance can totally level your profits in some cases. So,
especially in the coastal areas, yes, insurance might be your second biggest line item.
So speaking of pricing and quoting, I know you mentioned like the actual individual that's making the policy definitely plays a factor when you're doing like a primary residence.
Mm-hmm.
But I know that the amount of claims that you've done in the past can, differ on different people. Does that affect the pricing as well on, your future policies?
It does. Your claims history will affect what you're going to pay for insurance in the same way that if you're getting a quote for car insurance, the number of tickets that you've had in the past is also going to impact your rate, because the insurance company is trying to predict per year how many dollars of claims they're going to pay to you and then charge a small margin on top of that. Different people have different patterns in how they file claims. You have some folks that are habitual claim filers for anything small that happens. And then you have other folks that will only file a claim when something big and catastrophic happens. And those two people over time are going to develop a pattern in the minds of the insurance industry, and they're going to be offered very different prices for insurance. And so the advice that I personally follow is I purchase relatively high deductible policies, and I only use insurance when something catastrophic happens. I'm not the person buying a $500 deductible and filing a claim for every broken window, because I don't want to be seen by the insurance industry as a habitual claim filer. But as a result, even on my car. So I was parked in a spot, was getting out of the car, and somebody drove into my car door as I was, getting out of the car and did some damage to it. And that's probably going to be $2,000 to repair. I'm going to be paying for that out of pocket because I have a high deductible policy. And that's the price. So you have to maintain your own rainy day fund to handle those smaller things that happen if you want to go the high deductible route. But over the long term, it will save you quite a bit of money on insurance if you can swing it.
So Darren, you might talk in Insurance 101, what is a deductible and what happens if, you get something in your case, if somebody, like a claim that would happen?
A deductible is the minimum amount that you're always going to pay whenever a claim happens. And it's either a specific dollar amount. The most common is $2,500 or $5,000, or it's a percentage where you might see 2%, 5%. You're typically going to see those percentages on roofs. When companies get burned a lot on repetitive like wind hail claims, they start to raise the deductibles like higher and higher and higher because they're just getting burned year after year. And so it's a means of asking insurance, the insurer, the policyholder, to be reluctant to file a claim and not be quick to jump on the phone and say, hey, I have a $500 loss. And so the deductible raises the threshold so that the insurance company only sees the bigger stuff. And that ultimately ends up being way cheaper, because if you think about it from the insurance company's perspective, anytime a claim comes in, there are 6 or 7 different people that are having to get involved to touch it. There's lots of reports and inspections that get ordered. So the pure like transaction cost of processing a claim, even if it's a $1 claim, is probably $1,500 to $2,000 in just like people expenses. And so if they can get folks to sort of self-insure the small stuff, it ends up reducing the cost dramatically. But the reason why insurance companies offer really low deductible plans like $250, $500 is because not everybody can afford to pay $5,000 out of pocket when something happens. And they would prefer to pay more every month, but know that even if something small happens, they can call their insurance company for it. And that's why you see the range of options.
Okay. So our broker has told us about something called a clue report, which we encourage people to get. Have you heard of the clue report? And we were also told that like if you file a claim, it follows you around for like 5 years. I feel like it's like a credit, like a foreclosure record or something on your credit. Like it follows you around before it drops off and then makes you more attractive as an insurable party. Is that all correct? Is that the same thing on this side of the house?
I hear about clue reports more often when I was in the auto insurance side of the house, but yeah, it's essentially like a list of, it's no different than the list of speeding tickets that you've gotten. It's a list of the insurance claims that have happened, and it's the way that folks can paint a picture that says, okay, is this the person that files insurance claims frequently or rarely?
Okay. And it's like a 5-year window. Is that accurate? That it's about 5 years?
Yeah, it's typically about 5 years. And one of the things about, one of the benefits of running an insurance company that is specifically focused on landlords is there was this one error that we saw so many insurance companies making, which is they would ask someone during the quote, how many insurance claims have you had in the last 5 years? Okay. And the person would say, I bet 3. Well, 3 claims in 5 years on a homeowner's policy, that's a lot of claims. But what if you owned 6 doors as a rental property investor? Well, that's not very many at all. That's, that's not habitual filer at all. And so if you have a model that's built only for homeowners, you're going to misprice those folks who owned multiple properties. And that was one of the errors that we were glad that we could correct when we were building our pricing models.
How do you, okay, so that spurred a different question, and then I'll let Nico talk because this is how my brain works. How does Steadily navigate like, someone or like investors that own multiple LLCs and the properties are in the LLC names? Like, is there a way for you to funnel back up to say, okay, this is the main person, or is it by LLC? Tell me more.
Yes, it's based on the person. So we very much understand that you might have a different LLC for every single property, but ultimately it's all going to roll up to one or a consortium of folks that are investing in those properties.
Okay, so they can't dodge the bullet by thinking if I open up multiple LLCs, I can get away from claiming a bunch over here and you don't see me over here.
Our general experience is that folks can get away with playing games for a short period of time, and then they catch up.
So Darren, we talked about, the fix and flip, the builder's trust insurance. We talked about the short-term rental, the traditional landlord rental, but I'm going to ask you a question selfishly because I'm personally house hacking currently. And a lot of my clients are, looking to buy their first home. And, insurance and affordability is a little bit harder. So is there specific plans that Steadily has for house hackers, meaning people that live in a home and rent out, a basement or things like that?
So the good news is that a lot of traditional homeowners policies allow for house hacking. So you may not even need to get a traditional dwelling policy. And the homeowners insurance policy, you'll just want to make sure that you've got it in writing, in an email or, in one of the policy endorsements, like, hey, I've got somebody in the basement. But as long as you've got that in writing somewhere, you're good. And so that would probably be the most affordable option.
Gotcha. Okay. And I heard in an interview, Darren, where you talk about actual cash value versus replacement costs. You might giving like the quick overview, I guess, of what that is and what the difference is for insurance.
Most people, when they're buying an insurance policy, assume that they're buying insurance for the replacement cost of the property. And they're right. 95% of policies are going to be replacement cost. And what that means is, let's say that you have a 20-year-old roof. And if anybody wanted to buy that roof from you, they would say, man, those shingles are all falling off. Like, it's in bad shape. I'll give you $500 for that roof. And you're like, but wait, it's going to cost me 15 grand to replace it. So the difference between actual cash value is the actual cash value on that 20-year-old roof is $500. Replacement cost is $15,000. Which one do you want to be insured for? Almost everybody wants replacement costs, and so that's what most policies are. But there are rare situations where folks say, hey, I just need the depreciated value of this property, not the replacement cost. And that's what an ACV is, the actual cash value. The danger happens when folks call up their insurance agent and they say, that quote's too high. I need the cheapest policy you can get me. Well, the cheapest policy is an ACV, the actual cash value. But it's not going to give you the insurance that you need when something bad happens. Because in a very real way, you could have a $200,000 property that gets a tremendous amount of damage, and the ACV check is going to be $80,000. And so then what are you going to do? You don't have enough to rebuild. You don't have enough to pay off the mortgage. And so generally speaking, the folks that buy an ACV policy are not first-time investors. They know exactly what they're doing, and they have a very specific reason why they want ACV. And if that doesn't sound like you, get a replacement cost.
Yeah, that's good to know. I don't think most people realize the difference, and they'll just ask for the cheapest one. And if they have an insurance agent that isn't good at explaining that, they may never understand the difference and just think I just need the cheapest policy possible.
That's exactly right. And you don't find out until the day that you have the claim. And then they're like, that's
you
what
didn't
you
tell
buy.
me that.
So that's why it's important to have an agent on your side, right? So does do agents like have consultations with somebody to talk about what their intentions are, whether it's like a fix and flip or whether they plan on doing short terms to kind of cater the insurance policy towards them?
Absolutely. The most common pattern that we see from folks that buy from Steadily is they'll come to the website, go through all on their own, get to the quote page, play around with the coverages, and then they'll email or text or call and say, "Hey, this is the right thing, right?" And then they'll buy because they want that. It's not a cheap purchase. It's the first or second most expensive asset that they own, and they want to make sure that it's correctly protected. And some folks just pick up the phone from the start and just start asking questions, and either way is fine.
Right. And so I think it may have changed recently, but I know when we first started with Steadily, we did the website, we got assigned to a person, and that person was like, just email me or call me because otherwise another ticket gets opened every time you go to the website. And I already know your portfolio. I can do that. I think it may have changed a little bit. Now it's like a concierge service, but like there's a way for an investor who has worked with Steadily before to not just go on the website every single time, correct? Like what's the best way for a returning investor to engage with Steadily on the next property?
Yeah, getting really down in the weeds. So what we've moved to is a model where,
Internet.
no, this is great. Once somebody has purchased a policy, they're going to keep coming back to that person because we do want there to be continuity. But even if they go to the website and start a new quote on the website to figure out the price on a property, it'll still end up coming back to the folks that they worked with historically. And one of the things we've seen a ton of folks doing once insurance costs started rising is during the prospecting phase, when they're looking at different risks, they're using one of the estimator tools on steadily.com. So it's not the full quote. It just asks for the address and the year built and a few other things. And then it will say, hey, your price is probably going to be about here. And that helps folks to understand if they're looking at a property that's going to have some surprises when they go to insure it.
Yeah. Speaking of surprises, so, first time investors, first time people that are looking to buy their first investment property, what are some, in your experience, some common mistakes that people do with insurance, or what should they really look at when they're looking at their policy?
Replacement costs we've talked about, that's huge. Number 2 is the dwelling coverage, making sure that that limit is going to be high enough that if the property got completely flattened and you needed a ground up rebuild, that it's going to be fully done and they're going to hand you the keys on a fully rebuilt property without exceeding that limit. Because if you buy $180,000 worth of coverage and you go and hire a contractor and he's like, look, man, I've got a back order of 14 months worth of stuff. The only way your property is going to get rebuilt is if we agree that it's going to be $240,000. Well, you bought $180K of insurance, $240K to rebuild. That $60K, there's no free lunch. That $60K is coming out of your pocket. And so the way to make sure that you're actually going to get the property rebuilt in a fire or like a tornado situation is to have the replacement cost fully covered. And that's kind of on you to, as a first-time investor, to do the math and say, yeah, I'm buying the property for this amount, but what's it going to cost me to rebuild it? And that's where a thoughtful conversation with an agent and doing some research can ensure that you're buying enough insurance.
Okay. Can I ask, can you tell our audience what is the standard coverage in a typical policy with Steadily? And what are some things that maybe we don't think about, but would be add-ons? Like we think it's covered, but it's not, like flooding, pets. But like what's a standard policy cover and what other things should they think about that they may not realize?
The 2 biggest add-ons that folks don't realize are earthquake and flood. So earthquake and flood are not included in any traditional policy, whether homeowners or anything else, because those are enormously widespread events that can take out an entire state at one time. And so if somebody wants to get that policy, it's going to be separate. And a lot of people do buy separate. These days with flood, there's a lot more affordable options than there used to be. And so if you're in a floodplain, something to consider. A lot of people choose to self-insure on flood because they believe that if there is a flood, that there's going to be federal disaster assistance. And so they won't need insurance. I'm not going to opine on that, but that is a risk that some people choose to insure and some don't. And beyond that, umbrella coverage is something that investors start thinking about once their net worth starts to get above around 1.5 million. Because if you think about it from the perspective of a plaintiff's attorney, somebody gets, worst case scenario, somebody falls off of the second floor porch on your property and passes away. And a plaintiff attorney is now going to look at you as the owner and say, is this a juicy target or not? If you own a lot of properties and you have built up some level of wealth, you are now a juicy target. And that's where umbrella coverage comes in, where it allows you, instead of having $1 million in liability coverage, you can push that up to 2 million, 3 million, 5 million. And most people seek to have a liability limit that is equal to their net worth, plus or minus. And so to the extent that folks are building up their portfolio and becoming successful, that would be something they would want to look at.
Okay, now I'm going to be selfishly and ask a question. So you said liability coverage, and I asked about pet insurance before we jumped on because that's something we've been looking into, because as a landlord, a lot of times you make it pet friendly. What do you recommend to, should a landlord get pet insurance to cover themselves? How should they navigate that? Or should they get an umbrella coverage instead if they have enough properties? What do I do? What do we do?
With multiple properties, umbrella coverages are nice because they just cover you as an individual and your whole property. So that's one thing to consider. Specifically with pets, when people hear pet insurance, they think of two different things. They think of, what if something happens to the pet? And then they think of, what if the pet does something to someone else?
That's what I was thinking.
So the latter one is where the numbers get very, very big. And that is going to fall under liability. Most policies are going to have between 500,000 and $1 million in liability coverage. If you are allowing pets, particularly large pets, where they can do real damage to someone, then you might want to consider bumping that up to 2 million or more to give you greater protection. We'll go off on the tangent about dogs and big dogs and dangerous dog breeds for a second. So I've had dogs my entire life. I love dogs. The best dog I've ever met in my life was a bona fide pit bull. Sweetest dog ever is a pit bull. And if it bites someone, the probability that there's going to be a huge lawsuit because a pit bull did it, as opposed to if a golden retriever did it, is much, much, much higher. Only you as the landlord know what kind of dogs are going into your property. And so somebody's going to ask you oh, do you allow dangerous dog breeds? And you're probably going to say no. But then in your unit, and when you walk around and you're meeting the tenants and you're like, wow, that dog is 110 pounds. If it got loose, what's going to happen? You should really ask yourself, if that happens, are you going to be covered?
Okay. So it sounds like maybe bigger dogs, it's a thought that landlords need to keep in mind, is maybe the size of the dog would be something, because I know there's a restricted breeds list that a lot of insurance companies utilize. And then my head immediately goes to, what about ESA animals? I know some people that have ESAs that are German Shepherds, and German Shepherds are on some lists. So how does that work if you have to have the pet in the house?
Generally speaking, you're going to be looking for a coverage that does not exclude those.
Okay.
And so you would go to your agent and you would say, hey, I have to allow German Shepherds. So I need a policy that's going to cover them. Now, all of this goes back to real world risk assessment.
Yeah.
If you have an animal that's been trained since it was 6 months old to be a assistance animal, the odds that that animal is suddenly going to go rogue and do something to a little kid is probably vanishingly small because they've been desensitized. But on the other hand, if that's not the background of that animal, then you have more risk.
Okay. So Darren, I know we are running close on time, but we wanted to ask you, one last question. So we just talked about dogs, and I'm sure you have plenty of stories about dogs, but I was just curious if Steadily and you and your experience have had any feel good stories, where somebody had an insurance policy, something happened to them and you were able to help them. How could Steadily help investors?
Almost every day, we insure 100,000 properties across the country today. And so statistically, 10 of those properties are getting flattened every day, is pretty much what it works out to. And so we had somebody that I had met socially, didn't know them well, but they knew my name. And he emailed me and said, "Hey, man, I bought 2 properties in Missouri 3 months ago and got them insured, and they both got totaled. And you guys had the claim payments out to me within 13 days of the storm. Like, I can't thank you enough." I don't get those thank you emails often, but when they do, I get like a little bit tingly, and I'm like, this is why we do what we do. Like, we're making a thing that people need.
That's awesome. I love that. Because that's what it's all about, having a teammate, which, insurance companies are. They're a teammate to make sure that if something were to go wrong, heaven forbid, that you're covered. And having an agent, having a big company like Steadily that understands what goes in and out of landlord policies is so important. So that I'm so glad you shared that, Darren. My final question is, how could, Anna and I and our audience help Steadily grow? I know we talked a bunch about that, but is there anything specific that you guys have coming in the pipeline that you'd love for us to share?
Well, the question we always ask ourselves is, can we say yes to 95% of properties that knock on our door? And the goal is to, no matter what shape and size, geography, to be able to say yes. So that's where all of our energy goes. The point I'd love to end on is just that we are property investors, and we're not a multi-line insurance company. We have one product, and that's landlord insurance. All we do is insure rental properties. And so there's no situation that we haven't seen before 100 times. And when you text us or call us, we won't be surprised because we've seen it all. And we hope to be able to help out your audience.
Yeah. And coming from experience, my agent Trista has been awesome. Anytime I come up with a property, even if you're not under contract, you're just thinking of buying a property, they're happy to give you quotes and chat with you. So I've had a great experience, and I'm sure Anna can vouch for the same thing. But Darren, how can people reach out to you if they have any additional questions? I know this was kind of an overview of insurance, and I'm sure there's hundreds of more questions. Is there any way that our audience can reach out to you and reach out to Steadily team?
Yeah, well, the Steadily team is easy. You can just email support@steadily.com or on the website, you can chat with them. For me individually, I'm super active on LinkedIn. I try to post 2 or 3 stories about insurance or something else a week. And so just hit me up on there, and I'll be able to respond super quick.
Awesome. Well, thank you, Darren. I learned a ton. So if you have any feedback, please like, share, subscribe on Agent to Investor. And you can reach out to me at N Garcia Official on all social platforms. And you can reach out to Anna at
I'm @AnnaBylick_realtor on Instagram and Anna Bylick everywhere else. And I'm going to put in a request for Darren to go to like BPCon, because I know you guys are usually a sponsor, and we've met some of your folks. We took pictures and got cups because our agent actually told the folks going that we were going to be there. We were on some internal group chat, apparently, that she was like, my person is going. And she's like, you guys are steadily famous, because everybody knows that I told them you were going. So are you going to Vegas this year?
I'm going to be out there at least once, and hopefully making 2 or more trips out there, because yes, we've continued to invest more and more into the bigger pockets community, and folks over there seem to like us a lot. So I'm looking forward to making the trip.
Okay. So we'll go hit up your table and take pictures with you so we can post them on the gram.
Awesome.
That's right. Well, thank you again, and tune in until the next episode.
Bye.